What's going on? Alex here, and today I'm answering your questions from the YouTube comments. That's right, you post your questions, I answer them in a video. It's a beautiful thing. So today's question has to do with itemized deductions that are available for employees on Schedule A that they can take in lieu of the standard deduction. So let's take a look. This question comes from Andrea, and Andrea, thank you so much for your questions. I do appreciate it, and goes as follows. Since the tax change, besides real estate and medical, are there other deductions that can be taken in addition to the standard deduction for employees? Now, what are we talking about? By default, if you look on your tax return, if you are, let's say, filing single, then you'll see that there's a standard deduction that's applicable that's shown right here on the front of the 1040. And depending on the filing status, you can deduct different amounts as the standard deduction, which everybody essentially gets. And you can see here for single or married filing separate, it's $12,200. Married filing joint or qualified widower or widow is $24,400, and head of household is $18,350. Now, this is for 2019. The amounts will be adjusted slightly for 2020, but the idea is the same. And if you have enough itemized deductions on Schedule A, which we're going to review, then you may get a bigger tax benefit than just this $12,200 deduction, in which case your total taxable income is going to decrease, which would decrease the total amount of tax you owe generally. So it's the higher of either the standard deduction, or if you have enough itemized deductions to exceed the standard deduction, then you will itemize. And generally, that's the only situation in which it would be beneficial to itemize. Not 100% of the time, but just to keep it simple, it's the higher of. So either standard deduction or itemized if you can exceed the standard deduction. So let's take a look at Schedule A and see what we can possibly deduct. Now, Andrea already astutely pointed out two of the big deductions that are available, and that has to do with real estate and medical. Let's take a look at what that means a bit more closely. This first section is medical and dental expenses. And you can see here that there's a 7.5% threshold applicable. That's 7.5% of your AGI, or adjusted gross income. You find that by looking at the front of the 1040 and checking out this line here, adjusted gross income. Very important number for income tax purposes because a lot of other things are based on it. This is one of those things, the medical deduction. So adjusted gross income right here on line 8B, depending on what that amount is, 7.5% of that is then the base for the medical expense deduction. What does that mean? So if your AGI is $100,000, then this 7.5% threshold would mean that the math would play out as follows. You have 100,000 AGI times 0.075. This is 7.5% of your AGI. So your medical expense deduction in total would need to exceed at least $7,500 to even make it onto this line 4 over here. So let's say you had $5,000 in medical expense deductions in this case. You'd see $5,000 here on line 1. But once you calculate this threshold on line 3, you'll see the $7,500, which means that in this scenario, 0 of those medical expenses will actually make it to the tax return, meaning Schedule A, to then increase your itemized deduction. So it has to exceed this floor of the 7.5% of AGI to get any sort of tax benefit. Now, keep in mind that at the state level, the standard deduction is typically smaller, so the medical expense deduction can actually have more bang for the buck, so to speak. So definitely don't want to omit it from the return, but certainly input it into your tax software and see if there's actually a benefit at the state level, even if you don't get a benefit at the federal level. But that's the dynamic of how that works. In putting all this together, the medical expense deduction, as of the passage of the Tax Cuts and Jobs Act, I can tell you that for the most part, you have to have pretty high medical expense deductions to actually be able to itemize. And the two prominent situations in which I see that is when an individual is either gone through rehab, which can be very expensive. You could be looking at $50,000 a year, or they're in a nursing home or something of that nature, which can increase pretty substantially in terms of cost over time. So those are the two predominant things that I see just because of that floor related to the AGI that we see in terms of the medical and dental expense deduction. So typically I tell clients, look, I understand that tax benefits are nice to have, but this is one of those where you may not even want it, because that would mean you're either have gone through rehab or you have significant medical expenses. Not a great situation to be in generally. And given that the floor is so high, it's difficult to get over that threshold to actually be able to deduct amounts of your medical and dental expenses. So moving on down, we have the taxes area. And this was dramatically affected by the Tax Cuts and Jobs Act because the Act imposed a $10,000 threshold, assuming you're married filing jointly. It's different if you're married filing separately. But this whole category being composed of state and local income taxes, state and local real estate taxes, state and local property taxes, all this different stuff on personal property, all this different stuff. That's subject to a limit of $10,000 in total. And you could be married filing joint between two spouses. State and local taxes might be $150,000. In this case, you only get $10,000. Pretty dramatic. And this was significantly limited by the Tax Cuts and Jobs Act. So really, once that act was put in place in 2018, it became very difficult to itemize because the standard deduction was increased substantially. But one of the main drivers of itemized deductions was decreased. So you had a lot fewer people itemizing. That is the second major category that you can deduct. And if you have, let's say, wages that you earn, you may have state and local taxes of $50,000, but you'll still see this $10,000 amount. And that's why, because of the limitation imposed by the Tax Cuts and Jobs Act. Furthermore, you have mortgage interest. So if you own a home, at the moment, you can deduct the interest of up to $750,000 in principal. All right. If the principal on your home is higher than that, then you may need to allocate just that first $750,000. But at the moment, you do get the mortgage interest deduction. So it's fairly common to see this $10,000 limitation being hit here. So $10,000 would appear on line 7. And then the interest that you paid, assuming that the principal on the home is less than $750,000, you'll see that interest amount being reflected as well. So this is home mortgage interest, and in some cases, points that you prepay are going to be applicable here as well. And mortgage insurance premiums also can fall into this category, but you, as mentioned, do want to take a look at the instructions. There's some nuances there. The other important factor within this area is the investment interest expense, which is not subject to that 2% limitation that was applicable prior to the Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act eliminated all 2% miscellaneous itemized deductions on the federal level. But even before the Tax Cuts and Jobs Act, investment interest was not a 2% miscellaneous itemized deduction. That's why it's still there. And this number can be pretty significant if you, let's say, own multiple real estate properties and you have a significant amount of interest that is flowing through from all those different entities to your tax return. This could be a fairly high number in some cases. Again, not limited by 2% of AGI or essentially any other limitation as far as Schedule A goes. There are some other possible reductions that may be applicable, but that's for a more complex, involved video. Aside from the interest category, we also have gifts to charities. So charitable contributions essentially are limited if you are giving cash to 60% of your AGI. Again, coming back to that amount on the 1040 right here. So line 8B, you have to reference that again in terms of figuring out the max for charitable contributions. And the max varies depending on the type of contribution you make, the entity to which you make it, and so forth. So there's a few different limitations there. So definitely take a look at the instructions for Schedule A if you are making significant charitable contributions, just to make sure you're aware of the different limitations that can apply. But certainly, this is a category that may be applicable for employees. A lot of my employee clients make pretty significant charitable contributions, and they do get a tax benefit for it. Aside from that, you have casualty and theft losses from a federally declared disaster. And there's additional Form 4684 that you need to attach in that case. So if that's applicable, then certainly that may decrease the amount of taxes that you're paying in a particular tax year and qualify as itemized deduction. Aside from that, you'll see that a big category here has been taken away in that those 2% miscellaneous itemized deductions are gone. You have other itemized deductions and you have total itemized deductions, but no 2%. And the 2% itemized deduction category used to be where unreimbursed employee expenses were deducted. So if you were an employee and you were working and you had expenses that your employer required you to incur, essentially, and you could not get a reimbursement for those expenses, you can take them as a deduction on your tax return. In most cases, that would produce a tax benefit if the expenses were significant enough and you itemized. Those were the two thresholds you have to get over. Some individuals were deducting fairly significant amounts, and the Tax Cuts and Jobs Act eliminated that altogether for federal income tax purposes. Some states still allow it, so it's important to track it, but on the federal level, so far, that's not going to move the needle at all in terms of 2% miscellaneous itemized deductions. So unreimbursed employee expenses were in there, tax preparation fees were in there, investment management fees fell into that category, safe deposit boxes in some situations were also applicable, things of that nature. But they were all subject to that 2% of AGI. Again, AGI comes into play, a floor, and above that amount, you could possibly have an itemized deduction that may decrease your taxes. So to answer your question, Andrea, unfortunately, the options available for employees on Schedule A right now are fairly limited, and we don't have a lot of levers to pull to influence tax liability if you have, let's say, one individual who's an employee, or husband and wife, wife and wife, husband and husband, what have you, that are both employees and they don't have any other income, no rental properties, no business, things like that. Our options are limited. Our hands are pretty much tied in many of these cases. So hopefully that adds a little bit of color in terms of what can be done on Schedule A. If you just have W-2 wages, then again, unfortunately, hands are kind of tied in many cases. With regard to your second question, you ask, is there any benefit for a married couple to file a joint venture tax return over having a partnership in an LLC? Okay, got serious question here. Needs a serious answer. What are we even talking about, first of all? Now, the IRS actually has pretty good resources with regard to qualifying joint ventures. So if you just Google it, this website for the IRS has a good amount of the definition of a qualified joint venture, how to make the election to be a qualified joint venture, all of these different things. Very good website. Very clear. It's written in plain English for the most part. So why don't we take advantage of that? And first, take a look at reasons why a married couple may want to make the election not to be treated as a partnership. Let's read. Because a business jointly owned and operated by a married couple is generally treated as a partnership for federal tax purposes, the spouses must comply with filing and record-keeping requirements imposed on partnerships and their partners. Married co-owners failing to file properly as a partnership may have been reporting on Schedule C in the name of one spouse, so that only one spouse is credited for Social Security and Medicare coverage purposes. The election permits certain married co-owners to avoid filing partnership returns, provided that each spouse separately reports a share of all of the business's items of income, gain, loss, deduction, and credit. Under the election, both spouses will receive credit for Social Security and Medicare coverage purposes. So what was happening? Essentially, the IRS noted that there were married couples for which both of them were engaged in a business, but they filed a single Schedule C to avoid the complexity and the rigor and the cost associated with filing a partnership tax return. Because in general, if you have two individuals that are engaged in a business activity, they have to file a partnership return, but also personal returns. All right? There's additional costs involved, record-keeping requirements, accounting, a lot of headaches. So to avoid all of that, you had married couples that were taking all of the income and just including on Schedule C and just putting one spouse as the owner. A problem there is that while the income is still going to be taxed and it's still going to be reflected on the return, for Social Security and Medicare purposes, you only had one spouse making the payments on their own behalf. So if you look at the earnings record of a spouse that was not on the Schedule C in this situation, let's say for their entire life, their Social Security contributions would be zero based on this activity in which they were involved. So you can imagine how that can create a problem if, let's say, these two spouses are working together, only one spouse is getting the Social Security credit and the other one is getting nothing. If, for example, they were to divorce and the spouse that was not shown on the Schedule C is going to rely on that income from Social Security, that spouse may be disappointed because they haven't been contributing to Social Security based on the fact that the Schedule C was filed in the name of the other spouse. So this can get a bit hairy in terms of couples wanting to avoid the complexity of a partnership return, but the IRS wants these amounts to be reflected properly. So what's a compromise? Well, the compromise is a qualified joint venture treatment. All right, let's read. A qualified joint venture is a joint venture. You get it? It's a joint venture. It's a joint venture. Okay. A qualified joint venture is a venture that conducts a trade or business where, 1, the only members of the joint venture are a married couple who file a joint return. It's an important requirement. 2, both spouses materially participate in the trade or business. And 3, both spouses elect not to be treated as a partnership. A qualified joint venture for purposes of this provision includes only businesses that are owned and operated by spouses as co-owners and not in the name of a state law entity, including a limited partnership or limited liability company. So if you have that married couple, they're engaged in a business. What this is allowing them to do is avoid the filing of a partnership return if they elect to avoid filing that return and instead be treated as a qualified joint venture or QJV. A qualified joint venture would essentially enable the spouses to split the income, deductions, credits, and so forth between two Schedule Cs, one for one spouse, one for the other. So their Social Security and Medicare and all this other stuff can be properly calculated and reflected. Although still a partnership return has not been filed. So if husband and wife are engaged in a business, they are spending their time marketing, advertising, delivering excellent client service, and they don't want to be bothered with maintaining capital accounts and filing partnership returns and doing the accounting and dealing with their CPA at the end of the year for more returns than they want to, QJV treatment or qualified joint venture treatment may have its perks, okay? In that they don't have to file that separate tax return on an annual basis. Now, the important thing to note is that it must not be in the name of a state law entity, including a limited partnership or limited liability company. So what do I see very often? A husband and wife will open an LLC and then mistakenly believe that they can then make the qualified joint venture election. So what that means is that they were avoiding the filing of a partnership return when in fact they were required to file a partnership return for any tax years in question. So then you have to look at possible taxes, penalties, and interest based on the fact that that partnership return was not filed as required annually because they did not qualify to make the joint venture election because they were operating under an LLC. So if we scroll down here, there's a separate section where the IRS reiterates yet again that a business owned and operated by the spouses through a limited liability company does not qualify for the election. You can't do it. Only businesses that are owned and operated by spouses and co-owners and not in the name of a state law entity qualify for the election. This is a common misconception, and I see taxpayers get caught up in this all the time. Married spouses are eligible for the qualified joint venture election, but as soon as you open an LLC for that business, you've killed the prospect of QJV treatment. Now you're in partnership return territory, and there's really no way out of it for that particular business. So, husband and wife, spouses looking to engage in a business activity together, definitely avoid putting together an entity at the state level if that's your motivation, if you want to avoid filing the partnership return, because otherwise, if you have a state law entity like an LLC, then you do not qualify for qualified joint venture treatment. You're going to have to file the partnership return and deal with all of the administrative burdens that go along with it and costs as well. And you're not going to be able to simply split your Schedule Cs under this treatment. So, crucial point. Excellent question as usual. Thank you so much, Andrea. And if you found this video helpful, if you learned something, feel free to hit that like button, subscribe to the channel, leave a comment down below. And if you leave an interesting question, I just may address it in a video just like this. And with that said, thank you so much for watching. Let me make myself big again. Hopefully this was helpful. Thanks for watching.